Welcome to the Significance of Wealth podcast, where we explore the evolving landscape of wealth management, private investments, and collecting as both a passion and investment strategy. I'm Marty Salt. Today's episode takes a closer look at advanced tax strategy, an essential tool for high earners and those facing major liquidity events. Traditional deductions often aren't enough. Maximizing after-tax wealth requires a more sophisticated approach. Guiding us through this complex landscape is Jason Pueschel, founder and managing director of Alternative Tax Management. With over 30 years in financial services, including leadership roles at Salomon Brothers, Smith Barney, and Warburg Pincus, Jason brings an institutional lens to private tax planning, helping ultra-affluent clients leverage strategies across real estate, energy, and opportunity zones. Jason and Tom explore what truly moves the needle when it comes to reducing tax exposure and why timing, structure, and proactive planning are key. And now here's your host, Tom Ruggie.
Let's get into the basics a little bit. So tell us what are tax credits and how they differentiate from tax deductions.
So there's actually a huge differentiation between tax credits and regular deductions, which typically come in the form of depreciation or expenses that are related to some type of partnership or, private placement offering. So tax credits, I refer to them as like the pinnacle of tax mitigation, because it's not a deduction like depreciation and other types of expenses, depletion, and different things that you'll find in other programs that reduce your income that you're taxed on. It actually pays the tax liability that you owe. So if you have $1 of tax credits, it'll actually pay $1 of your tax that you owe versus a deduction that's going to reduce your income, and then you calculate the tax on the remaining income.
So along that same line, where is it that you see the use of these tax credits maybe being underutilized?
Well, tax credits are a little difficult to achieve. So, you have to have certain programs. I look at all the different programs that the government uses to incentivize private sector investments. And even the current tax bill, the things that they're trying to pass through the current legislation, it's really designed to meet an end goal, which is, currently boost economic growth. And how do you boost economic growth? Well, one way is you accelerate expenses and allow people to push all their expenses for equipment into 1 year. That's one of the things that they're working on. Tax credits, certainly a huge incentive that they put out there that really sparks development of different projects. And most of the tax credits that we see are related to environmental subsidies, such as, solar. We do a lot of work with solar development. And so right now, the government subsidizes solar through a 30% tax credit. And usually how the tax credit works is it's a percentage of the cost of the equipment involved. And so if you have $1 million of equipment for solar development, your tax credit would be $300,000, which is a subsidy that the government kicks in towards that program. So again, it's hard to get the tax credits because it is really an area that the government loses a lot of tax revenue. So they're pretty sparing in what they put forth with the tax credits.
Yeah. And we're going to talk about, some of the different options in more detail. And, there's several aspects to the tax mitigation, but, how do you really suggest beginning a conversation to help clients reduce their tax exposure with these vehicles?
It's a great question. As I stated before, I think if asked, every single person you talk to is going to say, yeah, please show me different ways that I can reduce my tax exposure. But, there seems to be a lesser positive impact, obviously, the lower the tax bracket. So generally, it's the higher earners that are going to be impacted most positively. Once you start crossing below a 24% tax rate, the lesser impact it'll have on your taxes. That said, it's really a holistic conversation, as I was saying before, where you're exploring with the individuals different positionings that they have for their assets. And the earlier that you can have a conversation with individuals, usually the more impactful your planning is. So as far as ways to position capital assets, certainly before you sell, oftentimes we run into people that they will approach us and say, I'm interested in doing a 1031 exchange. Great. When's your closing? Well, it was last Friday. Sorry, game over. You got to plan ahead of time. So it's fact finding. What kind of assets do you currently own? Do you have real estate? Are you a private business owner? Are you an entrepreneur? What type of capital assets can we pre-plan a positive exit for? From the income tax standpoint, are you a high earner? Do you get bonuses at the end of the year? Do you have certain things that are just, one-off impacts in a tax year where we could plan deductions for this year? And some of the programs, like you mentioned, oil and gas, spin off a target cash flow, where if you're having a significant income year this year, and we could pull that down, and your tax in the future year when you're receiving that income back is lower, it's a great strategy. So it's really just fact finding and learning more about these individuals.
Yeah, and that makes a lot of sense. I mean, we were guilty of having a client that we worked on with you, I think the last 2 weeks of the year, last year. So
last 2 days, I think.
I think that's when we executed.
Yes.
Yeah, but you did a fantastic job, and certainly appreciate it.
Yes.
One of the things that we've talked about is, I hear you talk about what you call the 3 pillars of a tax strategy. So could you review the major categories with us in that and give us some detail on each of them?
Sure. So I refer to the 3 pillars as, broad tax strategies that are really focused on the type of tax planning that you need, with the first one being capital transition strategies. Capital transition strategies ultimately are going to be something that's going to create a capital gain issue, whether it's, further segmented to real estate clients, where we could start the conversation with 1031 exchange and deferring the taxable situation with the sale of real estate, or any type of other that where we work with folks that are doing exit planning. Maybe they've got a privately held company that they're going to have a significant, event, and trying to mitigate the impact of a capital event like that. Or maybe they're transitioning the ownership structure of assets, which most of the time will also trigger some type of tax implication. So we could, again, plan ahead of time for the change of ownership. And so those are capital gains strategies. And in that bucket would fall 1031 exchange. You also mentioned qualified opportunity zone funds. That also is a great strategy with the capital transition crew. And charitable giving is also in there with charitable remainder trust. So you're donating appreciated assets and you're getting the full deduction value of those assets, and you're going to generate an income rather than take the tax impact and generate income off of a lower base. The second pillar is income tax mitigation strategy. This obviously impacts more of a broad-based group where everybody's somewhat trying to reduce their income tax, but generally it's the higher earners that are more positively impacted with strategies like oil and gas programs. And, we also do a lot of planning with Roth conversion strategies that fall into that income tax mitigation bucket. We've got some really neat strategies that allow for discounted Roth conversions where we're acquiring assets inside of an IRA, and there's a revaluation that occurs that drops the value of those assets significantly on paper. And then down the road, it's able to be, the capital event comes to fruition, or the cash flow comes back into the Roth IRA tax-free. So those have been hugely popular. And then the last bucket kind of crosses into the income tax bucket, but we talked about it before. The last bucket to me is tax credits. And the reason it's not in the income tax mitigation bucket is it really is its own animal. Like I said, tax credits are the best. They pay the actual tax liability, but also, kind of harder to find those. And solar development's one example of the tax credit bucket.
Wasn't planning to ask you this, but you brought it up. And could you elaborate a little bit on the advantage behind the Roth planning? Like perhaps give an example of that?
Sure, would love to. So the general strategy is we would take some assets, basically open up a self-directed IRA account, which is just a custodial account that offers the flexibility to acquire real estate, limited partnerships, private placements, different types of illiquid structures. we transfer money into that self-directed IRA and we'd acquire the assets inside the self-directed IRA. And then there is a third-party independent appraisal that takes place on the assets in that account. And based on a number of factors, for real estate, mostly it's ground-up development that we work with. And the rule is you're able to, from an accounting perspective, price in future construction costs that you're going to incur in the creation of the property and ultimately the leasing and stabilization of the property. You're able to price that into the current market value, and purposefully these valuations are driven as low as possible without breaking any rules, of course. And then, a good example is a program we work with right now that's already been revalued down 40% based on, the real estate construction. And so when you purchase, let's say $100,000 of that unit structure inside the IRA, it immediately prices down to $60,000 based on that independent appraisal. Then we're able to shift over to a Roth IRA. Next January, they get a 1099-R, which reflects $60,000 of income coming out where it would have originally been $100,000 to convert. And down the road, what you're ultimately, concerned about is the sale price of the portfolio, which, 4 years from now, 5 years from now, comes back into the Roth IRA tax-free.
Yeah, that's definitely an interesting concept. One thing I think that people, I don't know about if I'd say struggle, but, questions that come up is how to gauge what actual performance is on these types of investments, because it's not like a traditional investment that you can, monitor how your Apple or Microsoft is doing on a day-by-day basis. You're getting tax incentives and tax deductions and tax credits. And what's the best way to summarize the overall return? And I'm boilerplating this across all the assets because I know it's different for each one, but just as a generality.
Yeah, it's a good question. And it's often misunderstood when people look at some of the returns. There's so many moving parts, they're not factoring them all together, and they might misinterpret a return as being lower than it actually is. And here's what I mean by that. Maybe they're not factoring in the speed at which you're getting your capital back. Like the oil and gas programs, they're like a champagne bottle. They flow really quick for the first 2 to 3 years, then they plateau and they subside. The total return over 10 to 15 years might be 150%. And you're thinking, that doesn't seem that great to me. 150% over 10 to 15 years. Yeah, but if you're getting 100 of it in the first 3, it's the internal rate of return, and you're able to take that cash flow and deploy it into other investments. And then you couple it, you can't forget about the deduction. If you're getting 88% of your investment back in a deduction, and let's say you're in a 50% tax bracket, you invest $100,000, you're getting an $88,000 deduction. You just got a 44% return on investment from tax savings. So you got to build all the different components into your total return. What's the tax savings? What's the cash flow? The real estate programs, Tom, are probably a little bit easier to judge the returns. That's kind of what's my income stream along the way, and ultimately, what's the property sold at. And then on the other side of the spectrum, there's the ones like the solar developments that are really purely tax deductions. You got to combine your tax credit, which, some of the programs that we've worked with, you invest $100,000, you're getting about $80,000 of tax credits. And remember, that's as good as cash. So that's like you handing someone $100,000, they give you $80,000 back. So you've got $20,000 left invested, and then you get an additional $160,000 of depreciation. So you multiply the $160,000 times your tax bracket, that's your return from the depreciation. So it ends up being like 140% return this year if they pass that accelerated depreciation bill. So again, it's about looking collectively about the different components. What's my tax savings? What's my cash flow? What's my end capital disposition?
Yeah, and it's a bit of a moving target, but you have some pretty good software that helps to decipher these returns for the products that you offer.
And I'm guilty. I'm pretty much a numbers guy. So spreadsheets are my friend. I like to analyze and look at comparisons. So yeah.
So let's talk about the tax components a little bit. So I know most of the programs that you work with are structured as private placements. with some of those being some type of partnership or LLC format. Can you give us a little bit of an explanation as to why that is?
Yeah, great question. As opposed to, and this is a different animal for a lot of folks that particularly are accustomed to stocks and bonds. I mean, most people only have stocks and bonds and maybe some exposure to alternative investments in general, but even the alternative investment sleeve is underutilized today, even after years of advertisement and education. But to take it to another level, most everything that we work with is structured as a private placement because it needs to be either a general partnership or a limited partnership or a limited liability company. Think of it as an extended aspect of your personal wealth where you kind of hit a ceiling with what you can do on your own, unless you're going to start a million companies yourself, which some people do. But for the most part, for your average person, you can invest in these companies that other people are creating with the major advantage that it allows for these pass-through deductions. And without these partnership structures, you aren't able to receive these pass-through deductions that could apply to your personal income tax return.
Does it make sense to, for given that every client has a different situation, but I guess my underlying question is, are there circumstances where it makes sense for clients to utilize various different types of these programs together?
Absolutely, for sure. I mean, me personally, and a lot of the clients that I work with, it's the same as building a stock or bond portfolio. It's about diversification. For example, the oil and gas is a combination total return play where part of it is a deduction component from intangible drilling costs, and the other large portion of your return comes from the cash flow. Whereas the solar is almost exclusively depreciation and tax credits. And so when you combine them, you're reducing your risk. And let me further separate, oil and gas could also be separated by drilling funds, which is predominantly oil-based, maybe 75% oil, 25% natural gas. And then the reverse, we work with natural gas focused funds. So the more you could diversify, these are low correlated assets. It's just like building a stock portfolio. And when it comes to like the solar, when almost 100% of your benefit is tax deductions, you just don't want to be in a situation where you're putting it all on red, and saying, I mean, I feel really strongly that nothing's really going to happen to alter the tax advantages that you should receive. But you never know what happens in an audit or something happens. And if something were to get pulled away from your tax deductions on the solar, you're not left with the cash flow. So it's spreading out between the different asset classes to diversify your risk like any other portfolio.
Yeah, that makes sense. And you mentioned audits. So are there any red flags that could increase the risk of an audit when claiming certain types of tax incentives?